Hey everyone, this is the part 2 of the RBI circular related to December 2025 month. So let's start the discussion, guys. The very first thing is related to the liberalized remittance scheme LRS scheme. This is related to the submission of the LRS daily return by the authorized dealer category 2 bank in the entities that are full-fledged money changers. So this is the AD category 2 and FFMC. Okay, FFMC and AD category 2. So first we are going to discuss about the background of the circular, the background of this particular news, and then we are going to discuss this circular, a very simple one. What is the background? First you need to know what do you understand by the term LRS, which is liberalized remittance scheme. So what is liberalized remittance scheme? You can easily remit. The government is liberal enough to remit, to allow you to remit your money outside India. Okay, so in liberalized remittance scheme, the resident individual, let's suppose I am a resident individual, I can send the money abroad for the permitted purpose, right? I can send the money for permitted purpose abroad for the purpose of education. It can be for travel, it can be for investments. Let's suppose I would like to buy a share of Meta. I would like to buy 1 lakh rupee worth of shares of Meta. Can I do so? Yes, I can do so, because in liberalized remittance scheme, making investments is also permitted to the resident individuals, right? And what is the limit of LRS? So it is up to 2,50,000 US dollars in one financial year. So how much investment I can make, how much education investment or maybe travel related expenditure or medical treatments or gift I can enjoy in the LRS limit. I can enjoy the limit of 2,50,000 US dollar in one financial year. Okay, you must know this limit. So RBI here wants to track how much has already been remitted by a person in the current financial year, right? I have a limit. So RBI needs to take care about this limit, whether this annual limit is breached or not. And for that we do have a centralized information management system. We call it as CIMS. It is nothing but a reporting portal. It is a reporting portal, right? So as of now, what was going on? As of now, AD category 1 used to report each and every transaction for all of the entities. Now what is this AD category 1, AD category 2? So these are authorized dealers, right? These are authorized dealers. So we do have different categories. If we talk about the AD category 1, usually they are banking entities, right? Usually they are full services banks. So RBI gives them the AD category 1 license. When I talk about the AD category 2, these are the entities authorized by the RBI to deal in the foreign exchange for limited and for specified purpose. Now they are not full service banks. They are not full service banks. So mainly they are NBFCs, they can be certain cooperative banks or any other non-banking entity authorized by the Reserve Bank of India. They can become AD category 2 banks. So they don't have that much authorization or freedom I can say which is given to the AD category 1 bank. Sahi hai? In what kind of work they are doing? So basically they are retail and limited outward remittances or inward forex related transactions. So they are also involved in this outward remittances stuff. So obviously they need to also take care about the liberalized remittance scheme, right? So any kind of overseas education, medical remittances we can make through the AD category 2 bank also, authorized dealer category 2 entity also. Just like that we do have full-fledged money changers as well. These are called as FFMC. Now these are the entities that are authorized by the RBI for the money changing activities. So they are not banking entities, but they are just money changing entities, right? They can buy foreign currency from the individuals. They can even sell the foreign currency to the individuals for different purpose. They don't function like a bank. They don't function like a bank, right? So this particular circular is for the AD category 2 bank and for the FFMC. Now let's try to understand what is CIMS. CIMS is nothing but a portal. So it is a RBI managed online reporting portal. So banks, NBFCs, AD category entities, FFMCs, they all will be using the CIMS portal to submit the regulatory data, right? So RBI gets the data through the regulated entities via CIMS. Now the problem used to be is AD category 1 bank used to report each and everything related to the liberalized remittance scheme daily returns. So what AD category 1 bank has to do, they have to daily report on the CIMS platform of Reserve Bank of India. Let's suppose today is 7th of January. So 7th of January ko whatever transactions we are having, AD category 1 has to report that transactions to the RBI via CIMS portal on the very next day, right? So once 7th of January is concluded, on 8th of January, AD category 1 has to report the transactions. Now even if the LRS transactions were done by AD category 2 bank or maybe by FFMC, then also AD category 1 bank has to report that, right? Because usually what happens is AD category 2 bank and FFMC, they do have an account with the AD category 1 bank, and RBI seeks a centralized reporting via AD category 1 bank on the CIMS, right? So whatever transactions are happening in the AD category 2 bank or maybe in FFMC, they are also being reported by the AD category 1 bank only via CMS portal, right? Via CIMS portal. Now what is the amendment? What is the amendment here is RBI has now decided to give authority to the AD category 1 bank, AD category 2 bank, in the FFMC. They'll be getting the direct access to the CIMS, and they can report the data to the Reserve Bank of India directly instead of routing through the AD category 1 bank. So now AD category 2 bank and FFMC will be getting a direct access of this portal, and the reporting responsibility is getting decentralized. Now the responsibility is decentralized. Earlier it used to be centralized with the AD category 1 bank, right? This is the change in the provision here. So this is definitely increasing the compliance strength of our country, right? Definitely the RBI will be getting timely data from the AD category 2 bank and the FFMC as well. So it will be acting as a compliance control tool, right? So that's the update now, guys. The AD category 1 bank and entities and the FFMC may discontinue submitting the LRS transaction through the AD category 1 bank, and they can now submit directly to the RBI portal, CIMS portal. Okay. So before 31st December, they used to submit the data via AD category 1 bank. Now from 1st of January, they will be directly submitting the data to the RBI related to the liberalized remittance scheme. Okay. Next one is an update, a part of press release of the Reserve Bank of India. It was published on 2nd of December 2025. This is related to the RBI releases the 2025 list of domestic systematically important bank. Now what do you mean by D-SIBs? What is this systematically important banks? Domestic systematically important banks. So in India, as of now, we are having 3 domestic systematically important bank. SBI, we have HDFC, we also do have ICICI as the D-SIB. Now what do you mean by a systematically important bank? Now after 2008 financial crisis, everybody was quite scared. Why? Because a single entity, failure of a single entity can cause a widespread impact. We have seen failure of Lehman Brothers Bank caused a widespread impact everywhere, not just in America, but in the whole world. All the financial institutions, all the industries struggled because of that financial crisis. Why? Because nowadays the economies are interconnected, the financial systems are interconnected, and because of that, one shock can definitely lead to widespread destruction in terms of financial structure, in terms of economic disruption. So these are the too big to fail banks. We call them as too big to fail banks. That's why we call them as systematically important. You are systematically important. In finance, we do have systematic risk. That means the risk which is unavoidable. So these banks are so important that if they fail, there will be systemic risk emanating from this kind of failure. There will be a systematic risk. There will be a systemic risk emanating from these kind of failure. Why? Because that risk will be unavoidable. That risk will be unavoidable. So because of that, there are two types of SIBs, and that's why we classify the SIBs. We should know that these entities are too big to fail entities, and if they go down, if they fail actually, it will lead to widespread impact, not just a country specific event, but it will impact all the financial institutions of the whole world, right? So in terms of global ranking, we do have global SIBs. Now that is identified by the Basel Committee on Banking Supervision, right? So Basel Committee will tell which banks are global systematically important banks, right? And if I talk about the D-SIBs, domestic SIBs, that will be identified of central bank of the respective country. So if I talk about India, then RBI is going to decide and identify what are the domestic SIBs, what are the banks that are actually too big to fail banks. So as of now in India, we do have three banks: SBI, HDFC, ICICI. Consider the size of these banks. These banks have a huge size. They are enormous. They are having an enormous operations that even if any of the bank fails, it can disturb not just the country but the whole world, the financial institution of the whole world. If I talk about the HDFC Bank, HDFC Bank is not just a top bank of India, but the rank of the HDFC Bank is within top 10, I think, in India, and not in the whole world, right? In the whole world, the HDFC Bank rank is anywhere in top 10. Have a look at the size of HDFC Bank, SBI Bank, ICICI Bank. That's why RBI has classified these banks as a domestic systematically important bank, because we don't want any kind of global financial crisis again, right? And how RBI is classifying these banks? Domestic systematically important bank, if the bank is exceeding, in terms of asset, it is exceeding 2% of the GDP of the country, then in that case it can be a domestic systematically important bank. Maybe the operations have size, complexity, interconnections and irreplaceability. We can't replace SBI Bank, we can't replace HDFC Bank, we can't replace ICICI Bank. But when I talk about Yes Bank, IndusInd Bank, PNB Bank, any other bank, we can replace them. But it will take a structural shift to replace HDFC, SBI and ICICI, because they do have huge size. They do have huge operations involving complexity, interconnectedness, and they are actually irreplaceable. That's why we say they're too big to fail, right? So RBI annually lists these kind of banks as D-SIBs. RBI releases the list of banks as D-SIBs, right? What will happen if you are classified as a D-SIB? Then, because your size is enormous, you are having complexity in your business, you need to have some additional tier 1 capital. That means you need to keep some additional capital as compared to the other banks. So this is the list. On 2nd of December, Reserve Bank of India has released the list of domestic systematically important bank. We can see 3 banks are there in the list. ICICI Bank has to make an additional CET1 capital of 0.2% of the risk weighted assets. So whatever the risk weighted assets of ICICI bank is, ICICI Bank has to keep 0.2% of the RWA asset in additional CET1 capital. Why? Because it is a D-SIB. HDFC Bank has to keep 0.4% and SBI Bank has to keep 0.8%. So this is the additional capital criteria for the D-SIBs. I hope it is clear, and this can be important for your examination, right? Next one is related to the directions to amend the credit information reporting. Now we do have a credit information reporting mechanism in India, and RBI has amended the directions related to the credit information reporting. So this was released on 4th of December 2025. There were so many directions. Why? Because they are related to commercial banks, small finance bank, local area banks, regional rural banks, right? UCBs, RCBs, all India financial institutions, NBFC, asset reconstruction company and credit information companies. All these entities are impacted because of these directions, right? It's a very simple one. Let's quickly try to understand it. Let's take the commercial bank wala direction and we are in detail discussing the commercial bank wala direction, and then you can understand what all the amendments are. Basically the amendments are simple and same only. What are the amendments here? Acha, first you need to understand the criteria of CI in CCI, right? There are credit institutions. There are so many banks like SBI, like PNB Bank, like ICICI Bank. All these institutions are lending credit or offering credit. Now whatever credit they are offering needs to be reported to the credit information companies as well, CICs also, right? Whatever credit they are offering needs to be reported to the CICs also, and we have done an entire circular related to the CIC, which is also going to be important for your examination, right? So the earlier guidelines stated that if you are a credit institution, right? If you are a credit institution, you need to submit the data to the CICs on a fortnightly basis, or on a shorter interval, right? Now, in this particular circular, they have mentioned clearly that upon a review, it was proposed to amend the extent instructions to weekly incremental submission of the credit information by the CIs to the CIC, along with the measure to facilitate faster data submission and rectify the errors. So as of now, we are having weekly incremental submissions instead of the fortnightly basis, right? So let's start with the discussion related to this credit information to the CICs, guys. So from now onwards, we need to report the incremental data on a weekly basis, right? So the CI, the credit institutions, will be submitting the credit information as on 9th, 16th, 23rd and the last day of the month to the CICs. So now the credit institutions, how they are going to submit the data? 9th of every month, 16th of every month, 23rd of every month, and the last day of the month, the information needs to be submitted to the credit information companies, right? So this is the new methodology now instead of fortnight basis. A credit institution shall also submit a full file. So they also have to submit a full file containing the credit information records on the last day of the month to the CIC by 5th of the next month. So the cumulative data, whatever happened in the month, needs to be submitted in the full file by 5th of the next month. So let's suppose it's the January data. I'm done with January. Weekly reportings will be there, weekly incremental reportings will be there, and at the end of the January, I need to submit the full file to the credit information companies on by 5th of February, right? This will be the timeline now. Now whatever data we are submitting on 9th, 16th, 23rd, right, shall be on incremental basis only. We need to only furnish the incremental accounts, like whatever changes happened as compared to the last reported data in terms of accounts opened since the last reporting reference was done, accounts wherein the relationship between the borrower and the CI has ended. So we just have to give the updates. Here, right? Now how the CIC shall report the data? On the Daksh portal. On the Daksh portal, the CIC shall report the data by giving a list of the credit institutions which fail to adhere to the data submission timeline. So let's suppose there are certain credit institutions who were not able to submit the data timely. The CIC will report to the Department of Supervision via the Daksh portal. Right? And what do you mean by Daksh portal? It's nothing but an online supervisory and compliance monitoring portal of Reserve Bank of India. So let's suppose Reserve Bank of India wants to supervise or check whether compliance has been done or not, then in that case the data will be reported through the Daksh portal. So it's nothing but a digital platform to monitor whether the banks and the regulated entities are following the RBI rules and they are submitting the data on a timely manner or not, right? Earlier the compliance was fragmented, and now we do have a consolidated portal where we get single real-time compliance status related to each and every report, right? And the same data is included in the RBI Credit Information Company's Amendment Direction 2025, can be important for your examination, right? Can be important for your examination. So we discussed that how to report the data. The credit institutions are going to report the data related to credit to the credit information companies. 4 dates are there: 9th, 16th, 23rd and the last day of the month. We just have to give the incremental data. Whatever the updates are there, we have to share that. But you need to share the full file submission once a month on the 5th of the next month, right? On the 5th of the next month. So this is the circular, guys. Next one, Reserve Bank of India Rural Cooperative Bank Miscellaneous Amendment Direction. We can see that there are so many amendments in the month of December, right? In the month of November, we do have certain consolidation of so many circulars, and now in the month of December, we do have so many amendments, right, in the directions. Now this is not so important, but you need to know the crux of it. Here this is related to the rural cooperative banks, right? So the bank should clearly display the name, everywhere in the stationery, on the stationery items, on the publicity material, in the website, right, on the mobile application, advertisement, name boards, etc. So the name should be same as mentioned in the certificate of registration and the banking license granted by the Reserve Bank of India, right? So whatever short forms you are writing, definitely that is permitted. It must be ensured that the full name appearing in the banking license should be shown along with such kind of short form also. So it's more related to name disclosure stuff, right? Not so important for the examination. What can be important for your examination is norms for inclusion of a STCB in the second schedule of the RBI Act. So an STCB can be included in the second schedule subject to the following conditions, subject to the following compliances. The first compliance is CRAR, capital to risk asset ratio, right? We also call it as CAR, capital adequacy ratio. Should be at least 3% more than the minimum CAR requirement applicable to the bank. So whatever the minimum CAR is, now you need to tell me what is the minimum CAR as of now in India. Please let me know in the comment section, okay? Please do let me know in the comment section. So what is the minimum CAR? Plus 3%, at least 3% more than the minimum CAR should be there, and no major regulatory or supervisory concerns should be there. So we can include that in the second schedule also. It is permitted to be included in the second schedule also. And this information shall be based on the assessed financial and findings of the NABARD inspection. So definitely the data should be inspected by NABARD there. Whatever financial data is being given by the STCB should be assessed by the NABARD of the NABARD inspection. So NABARD ने जो भी inspection किया है उस हिसाब से आपका यहाँ पे data होना चाहिए, right? Now this one is related to the urban cooperative banks, related to licensing, scheduling and regulatory classification. Okay, so it was also released on 4th of December. There are so many notifications released on 4th of December. So what is the crux of this circular? The very first thing that RBI wants to clarify for the urban cooperative banks is the UCBs mean primary cooperative banks as defined under the Banking Regulation Act. So urban cooperative banks licensing, the very first thing that we are talking about in this particular circular is related to licensing of the urban cooperative banks. The RBI will not consider new proposals to start fresh UCBs. No new proposals will be evaluated as of now, will be considered by the RBI related to fresh UCBs, urban cooperative banks, or the conversion of the cooperative credit society into UCB. So now new proposals related to the UCB or the conversion of the cooperative societies into the UCB will not be considered as of now. So no new UCBs will be allowed. Why? Because the RBI is focusing on regulating and strengthening the existing UCBs. Rather than involving new UCBs into the system, why not to first focus and strengthen the existing UCBs, right? So this is mentioned in this particular circular in the licensing requirement, Now coming to the categorization of the UCBs, there is a tier system. So there are 4 tiers here, okay? The whole idea is, if you are falling in a smaller tier, right? If you are a smaller bank, then it implies simple regulations, and if you are big in size, then definitely more and more regulatory rules and regulations will be applicable on your bank. So there are 4 tiers in the UCB. If I talk about the tier 1, all unit UCBs and salary earners UCBs will be there, and other UCBs with deposits up to 100 crore. So if you are having deposits up to 100 crore, you will be falling in the tier 1 criteria. If you are having more than 100 crore deposits but up to 1000 crore deposits, tier 2 is the criteria for you. Tier 3, deposits more than 1000 crore but up to 10,000 crore, and even if deposits are crossing 10,000 crore, then tier 4 classification is for you, right? But if you are all the unit ECBs and the salary earners UCBs, irrespective of the deposit size will be the part of tier 1, right? They will be part of tier 1. So now what is the meaning of this unit UCB or the salary earners UCB? If I talk about the unit UCB, a UCB that operates only from one branch. If I am a UCB, an urban cooperative bank, and I am operating only from one branch, I don't have too many branches, I don't have multiple branches, so my presence is limited, right? If I talk about the geographical presence, it's quite limited, right? So that's why I am a unit UCB. Salary earners UCB, that means a cooperative banks focusing on mainly the salaried employees, right? Formed mainly for the salaried employees. So members are usually from a particular company, specified institution or defined group of employees, right? So these are the unit and the salary earners UCB. The deposit criteria won't be applicable on the unit UCB and the salary earner UCB. Rest deposit criteria is there. So this criteria can be important for your exam. Okay, this criteria can definitely be important for your exam. I have pasted the screenshots from the circular itself, right? And guys, in case if you are having any queries related to anything, related to your preparation, right? So I have made a group. If you type CA Prateek Finance on Telegram, you will get the link of my group. You can definitely join that. I frequently share multiple things related to finance content on that channel that can help you for your preparation. You can also ask your queries on that channel. You can connect with me directly on that particular channel, right? Next one, basis of deposit calculation. So the audited balance sheet of the 31st March of the previous financial year will be taken as a basis for the deposit calculation. Now how to calculate the deposits, on what date to calculate the deposit? So this is the date, not so important for your examination. And you will be gradually be transitioning. If a UCB moves to a higher tier due to deposit growth, let's suppose I used to be a tier 1 UCB, now I am classified as a tier 2. So the transition will be gradual. Okay, the transition will be gradual. It's not like that I have to face too much pressure related to regulatory compliance, but the RBI will allow me gradual increase up to 2 years to meet the higher requirement, higher regulatory requirement, because I moved from tier 1 to tier 2. Now I have a different regulatory requirement. RBI will give me at least 2 years to comply with the new requirements, right? So this is the provision here. And if I talk about the eligibility condition for inclusion in the second schedule, if you want to become a scheduled bank, then you need to comply with the provisions of capital adequacy ratio and the regulatory track record that we have already discussed, right? Now let's discuss about the circular commercial bank credit facility. So this is again an amendment direction 2025. This is regarding gold metal loans, okay? This is regarding the gold metal loans for the commercial banks, right? So this particular circular is applicable on the small finance bank also. So there is one more circular which is related to small finance bank credit facilities. So we'll be definitely discussing about both the circulars related to commercial banks and small finance banks together only, okay? Amendments to the gold metal loan schemes. It was released on 4th of December 2025 on the RBI website. I have covered it in a separate video as well on YouTube, but we will be discussing this particular circular in this video as well, because this is the consolidated video for all the circulars related to December 2025, right? The first thing that you need to understand is the definitions. The first thing is gold metal loans. Then we have the import linked gold metal loans. Then we have the GMS linked gold metal loans. What is GMS? Gold monetization scheme. Let's try to understand one by one. The very first thing is gold metal loan. What is the meaning of gold metal loan? The bank is actually lending the actual gold. If I am a bank, I am not giving loans, but I am actually giving physical gold, the gold metal instead of cash, to a jewelry, to a jeweler, right? Let's suppose if somebody is involved in a jewelry business, I am a bank. Mr. A is in the business of jewelry making, right? So Mr. A is in the business of jewelry making. The bank has given loan to Mr. A, actually in the form of metal, actually in the form of gold metal rather than cash. So I'm not giving a loan in cash, I'm giving a loan in physical gold metal, right? I'm offering that to a businessman involved in the jewelry business or to the MMTC. Okay, what is MMTC? Later on we can discuss that. What is MMTC? Later on we can discuss that. So here I am offering the loans in the form of gold, right? So there are two types of gold loans here: import linked gold, import linked GML and GMS linked GML. Let's try to first understand the meaning of import linked GML. So this is a gold metal loan. Acha, gold loan is completely different from gold metal loan. In gold loan, the bank is taking the gold and the bank is offering you the cash, right? But here, the bank is actually offering you the gold metal, not cash. That's the difference. So first one is import linked GML. How the bank is arranging the gold? The bank is actually importing the gold. The bank is actually importing the gold and the bank is giving you the loan in the form of gold metal. The bank is giving you the loan in the form of gold metal. So this is a kind of import linked gold. Why? Because this particular nominated bank has imported the gold and you guys can only pay in cash. The repayment will be only in cash, not in the form of metal. Okay. The import linked gold metal loan will be only repaid in the form of cash. That's a point to be noted. The borrower can be domestic person who is involved in jewelry business, or even a jewelry exporter can avail this kind of loan, right? Because we all know that if I am involved in the business of jewelry making, then I need physical gold to make the jewelry. So can I say that jewelry becomes my inventory here, gold becomes my inventory here, that's a raw material I'll be using for making jewelry. So that's why I can take loan in the form of physical gold from the nominated banks. This is a first type of GML, which is import linked GML. Here the nominated bank is actually importing the gold and they are offering the gold to the jeweler, whether domestic or whether export jeweler, in the form of physical gold, right? But the repayment will be only done in cash. Now what is this MMTC? You can give loans to jewelry business or MMTC. Now what is this MMTC? MMTC is nothing but Metals and Mineral Trading Corporation of India. It's nothing but a public sector undertaking of the government of India and one of the India's largest importer of precious metal, including the gold and jewelry, right? Including the gold and silver. So again, the MMTC can also secure the loan from the nominated banks in the form of gold metal. That's also permitted. Okay. So MMTC is also producing the gold coins in India. So that's why they can also procure the gold metal loan. Why? Because they are also using gold as a raw material for manufacturing the gold coins. Sahi hai? Then the next criteria that we are having is the GMS linked GML. The first thing was import linked GML. Here what we are doing is, a nominated bank is actually importing gold. The nominated bank is actually importing the gold and offering the gold metal to someone who is into the jewelry business or MMTC or MMTC, and the borrower has to make the repayment actually in the form of cash, not in physical metal. Next one is the GMS linked loan. Now GMS stands for Gold Monetization Scheme. What is Gold Monetization Scheme? In India, if I talk about households, if I talk about institutions or temples, they have a large quantity of gold. They have a huge quantity of gold, right? What they can do is, they can deposit the gold. They can deposit their gold in a bank, and the bank will start paying them something like interest on the gold deposits. Now this scheme is called as the Gold Monetization Scheme. Right? This scheme is called as the Gold Monetization Scheme. So what is GMS linked gold metal loan? Now the bank is actually given again gold metal as a loan, physical gold metal as a loan. But how the bank is sourcing this gold? From the Gold Monetization Scheme. Whatever the bank has taken the gold in the form of deposits from temples, from individuals, from households, right, from corporations in the GMS scheme, and bank is actually paying interest on this GMS scheme. That's why these people are also interested in depositing their gold with the bank. They are also interested in keeping the gold with the bank. Now the bank is offering physical metal to the borrowers. Now the borrowers may pay in cash or actual in gold or in physical gold, right? Or in physical gold. So that is the case. So if it is the case of import linked GML, the borrower has to compulsorily pay that amount in cash. But if it is a GMS linked GML, then the borrower can pay it in cash or either in the form of gold also. Now what are the eligible banks for the import linked gold? Only nominated banks by the Reserve Bank of India can offer this kind of facility. When I talk about the GMS, Gold Monetization Scheme linked GML, only designated banks under the Gold Monetization Scheme can offer this kind of facility. And the borrowers we have already discussed. You are into the jewelry business, maybe domestic, or you are exporting it, doesn't matter, or the MMTC, right? Only for minting gold coins in India. Only for the purpose of minting gold coins in India. Basically, the whole idea is you must use gold as a raw material for creating some other product. That's why they are giving you directly gold as a raw material, right? So this is the whole idea, and this is going to support your working capital need. Now, the person who are involved, people who are involved in jewelry business, they don't have to secure first working capital loan, then they need to buy gold. They are directly getting gold, right? So it will definitely help in their working capital need. It reduces the cash based gold purchases, right? They will not be purchasing gold in physical cash, which is a big problem in India, unaccounted for money. They have to purchase the gold in a loan kind of a manner from bank directly. So they have to pay it in via bank only, not in cash. And it also reduces the foreign exchange uses here, right? So again, if somebody has to buy gold from foreign country, they have to use foreign exchange. That has also been avoided here. Now, what are the prudential and risk rules which RBI has stated? You need to have an internal policy. If you are a bank, you are offering gold metal loans, then you need to make an internal lending policy first, right? You need to set limit on each and everything per borrower gold quantity. What should be the outstanding amount of the gold lent? You need to monitor the end use of the gold as well. Why? Because actually your gold is going whether in the working capital need or not. Ultimately, the borrower should not trade gold. That borrower should be using gold for producing the products, right? For producing the products. That's what the main aim here is. That's what the main aim here is. And borrower gold, the borrower cannot use the gold for selling or exporting directly as it is a raw gold. So let's suppose I am into jewelry business. I have secured a gold metal loan from any nominated bank. Now I can't sell that gold as it is because I have to convert that in jewelry. I can't sell that gold in the raw format. Otherwise, it will kill the crux of the circular, right? Otherwise, it will kill the crux of the circular. So, GML linked loan will be treated as any other kind of loan. So, you need to have capital adequacy norms also provisioning norms will also apply. So, all the norms related to capital adequacy and provisioning will also apply. And if I talk about the valuation, daily valuation needs to be done using the LBMA gold AM price or the RBI USD INR reference rate. Now, what is this LBMA? It is nothing but London Bullion Market Association, right? So, gold prices are determined by this particular association and you can just take the rate as a reference rate for the valuation purpose here, right? This is the criteria. And you guys must be knowing this was an update recently on the RBI website, or for all the GML loans, gold metal loans other than lending to jewelry exporters, a bank may fix repayment tenure as per the policy subject to a ceiling limit of 270 days, right? So, actually the bank has maintained the limit of 270 days here. The bank earlier proposed a criteria of repayment in 180 days, but now they have extended it to 270 days. So, please do remember, if you are a jewelry exporter, then as per the foreign trade policy, whatever the foreign trade policy of India is there, you need to repay the loan timely as per the FTP. But if you are other jeweler, not in the jewelry exporter side, then you need to maximum pay that loan within 270 days. Now, this is important for your examination. 270 day limit is important for your examination, definitely, right? And the same thing is also written for the small finance bank in one more circular published on the 4th of December 2025. You can later on check out, each and everything is same here only. 270 day timeline will be important, right? Next is the RBI announces the open market operation purchases of the Government of India securities. This is a news which was there in the press release column of RBI website on 12th of December. So, what this open market operation is all about? RBI is purchasing government securities. So, financial institutions like banks do hold government securities as well, right? Now, if RBI is actually purchasing these government securities, then RBI must be infusing liquidity, right? RBI must be infusing liquidity in the banking system, and the whole idea of doing this kind of OMO purchases, which is called as open market operation purchases, is to infuse liquidity in the banking system, right? So, by this move, RBI is actually infusing liquidity into the banking system. You can see that these are the securities and these are the maturity period. I can see that all the securities are having a long tenure only, and that's what I can say is a classic example of infusing durable liquidity into a system is, right? The next circular is related to the Commercial Banks Undertaking of Financial Services Amendment Direction 2025, right? So, let us discuss about these directions related to commercial banking undertaking of financial services. The whole concern here is what kind of non-banking or financial services can the bank provide? Now, can bank provide non-banking services or maybe financial services like selling mutual funds, like selling insurance, and to what extent they can do so, right? So, this is the background, guys. Here we are discussing about what kind of non-banking and financial services the bank can provide. And this direction will be clearly defining like what banks can do directly and what they can do via the group entities. So, what they can do directly and what they can do indirectly in terms of financial services, providing financial services. So, the very first definition which is there in this particular circular is agency business. The banks can act only as an agent. Now, the agent is not taking any kind of risk. The agent is just selling a product or it is helping someone to sell the product, and they are able to secure a good amount of commission for that. So, the banks can only act as an agent. They can't take risk here. That means the bank can sell the third party financial products, but they can't take the risk emanating from that trade or the financial product. That means only agency business is allowed. So, let's suppose banks are selling insurance policies for the insurance company. That doesn't mean, let's suppose if after some time a claim arises, due to that maturing of the insurance policy, so bank will be liable for that? No, right? Bank is just acting as a facilitator here rather than the insurance company in itself. Bank is selling mutual funds here, right? So whatever the financial product is, the final entity, the counterparty, maybe the insurance company or maybe the AMC, asset management company for mutual funds, will be liable for the entire risk. The bank is only acting as a facilitator, right? Then we have referral services definition. Now what do you mean by referral services? The banks only refer the customer to the third party, like bank assurance. We have partnership of banks with multiple insurance companies. Let's suppose HDFC Bank has partnered with LIC, for example, for the bank assurance agreement. Now HDFC Bank, we know that bank is having a good amount of footfall. Customers are coming regularly in the bank, but that doesn't happen in insurance company. Have you ever कभी आपने LIC का ऑफिस या OICL का, ओरिएंटल इंश्योरेंस, और मे बी यूनाइटेड इंश्योरेंस, have you ever visited the office of these insurance company? High possibility that no, right? Why? Because insurance penetration is still at a very lower level in India, and that's why they use the banking channel as a front. They use the banking channel as a front to sell their insurance products or mutual fund products. So bank is providing a referral service. They are just referring the customers to the third party. They are not directly involved in processing or servicing anything. The processing activity, servicing activity will be done by the company, mutual fund company or the insurance company or whatever the case may be. There won't be any involvement of bank in processing or servicing, right? Now what do you mean by financial services? It can be businesses like mutual funds, selling mutual funds, selling insurance, pension funds management, portfolio management fund, investment advisory, stock broking, asset reconstruction, exchanges, depositories, payment system and services like that. All these things are financial services. Bank cannot provide these kind of financial services now, right? So that's why there should be a board approved policy. A bank needs to have a board approved policy for insurance distribution, for mutual fund distribution, for each and every activity that the bank is conducting. Why? Because they can only be in agency business. They should not undertake any kind of risk emanating because of these financial products, and that should be clearly defined. That should be clearly defined, right? The overall risk appetite will remain with the entity selling the offering the final product. We are just acting in the bank's capacity as a facilitator, right? As a facilitator. So the core banking activity, what banks can do and how? So the core banking activities like taking deposits, lending, all these activities the bank will be involved in, must be done only departmentally by the bank itself, right? So I can say these activities the bank will not outsource. यहाँ पे तो बैंक खुद ही कर रहा होगा. These activities will be the these are the activities in which I will say these are the core activities of a bank, right? So one business, one entity principle. So ideally one form of business should be undertaken only one entity in the bank group. Let's suppose HDFC. So HDFC is having HDFC Bank. HDFC Group is also having HDFC Life, which is actually in the insurance side. HDFC also have HDFC AMC, which is selling mutual funds, asset management company, right, which is involved in selling of mutual funds. HDFC Life is offering life insurance products. So every entity is doing its own business, like bank is only involved in taking deposits and lending money. They are not selling insurance. They are not selling mutual funds, right? They can act in the capacity of an agent, but they can't solely do that, right? So specialization is highly desirable here. Specialization is highly required here to avoid duplication and conflict of interest and risk concentration, right? Lending through group NBFCs or HFCs. Let's suppose I am a banking entity. Now I have a NBFC also. I have a housing finance company also. Can I lend through group entities? Yes, that is allowed, but with strict conditions. NBFC must follow the upper layer NBFC regulation. The bank credit restriction will also apply, right? So restrictions like loans against the parent bank shares. Now they can't give loan against my own shares. I am HDFC Bank. I have a NBFC also. Now that NBFC cannot give loans against the shares of HDFC Bank, there are many restrictions. There are multiple restrictions here, right? Now you need to have just a quick overview of this circular and don't go into too much details of each and every circular. Why? Because if you see the data related to the December 2025 circular, you will be surprised that there are close to 60 plus entries on the RBI website, right, in the directions. So that's why I'm telling you guys, most of these are amendment directions, and whatever I'm teaching you here in these classes will be sufficient, right? So no worries about the sufficiency of the data. Activity is not allowed departmentally. Now let's suppose I'm a bank, HDFC Bank. I can't do mutual fund business also in it. I can't do insurance business in it. I have to create separate entities. Right? Prior approval of RBI is required when you are entering into any new form of business. Let's suppose HDFC Bank is going to start a new business. Maybe in the insurance, they are already in insurance, by the way. This is just a hypothetical example. Then they need to take the prior approval of RBI. Why? Because they are already a bank. So that's why they have to take new approval, fresh approval from RBI, right? Or maybe they are additional investment in group entities. They are doing some additional investment in group entities. Then also they need to take permission of Reserve Bank of India. And the investment regulations are very strict. The limit is based on the bank capital. So maximum 10% investment in a single entity. If you are a bank, you are making investment in an entity, it should not cross 10% of your capital, right? Because this is a single entity, and in aggregate, let's suppose you have invested in multiple entities, aggregate limit is 20% for all the entities, right? However, there are certain exclusions like held for trading investment. Let's suppose you are not doing some strategic investment, you are just trading. I've just acquired stake in a company for trading purpose. I'll sell it in the meanwhile by booking profits. I'm just a trader. Then that's in the exclusion. Up to 30% equity acquired via debt restructuring. If the transaction is being facilitated via debt restructuring because of the provisions of the debt restructuring, then up to 30% is allowed. Okay. So these two limits and these two exclusions are going to be important for your examination. Okay. Limit based on the investee capital. It is not that much important. Still, I will discuss. What do you mean by investee? If a bank is investing in some NBFC, for example, or a mutual fund company, then the bank is the investor and these companies are the investee. So this limit is pertaining to bank, specifically bank's capital. But this limit is related to investee capital. So there is two-sided limits. There are two-sided limits here, right? The first one is less than 20% investment. If less than 20% investment is there, no RBI approval is required, right? But if your investment is crossing or is equal to 20% of the investee capital, let's suppose HDFC Bank is investing in a mutual fund company and it is actually crossing 20% or is even equal to 20% of the capital of the investee company, then HDFC Bank has to take the approval of RBI. Why? Because this will create an associate company. This will be a group company. That's why this is the logic behind it, right? What do you mean by an associate company? Let's suppose HDFC Bank, this is a hypothetical example, 0%, 20%, 50%, 100%. Let's suppose HDFC Bank is holding 20% or more of equity share capital of A Limited. Then A Limited will be subsidiary, will be the associate company of HDFC Bank. If HDFC Bank is holding more than 50% of, say for example, B Limited will be the subsidiary company. B Limited will be the subsidiary company of HDFC Bank. If HDFC Bank is holding 100% of equity share capital of C Limited will be a wholly owned subsidiary. Right? Less than 20%, no problem at all. But 20% or more, now this is your associate company. You have a significant influence. Once it is your associate, you have a significant influence. That means you can influence the decision making of A Limited. Take RBI approval. Up to 50% it will be your associate company only. So 20% or more than 20%, up to 50%, that's your associate company. More than 50%, now you have a significant control. Are ordinary resolution, so you only will be able to pass. You have more than 50% shareholding. You can even pass a resolution or your own, right? So you have a significant control. That means it is your subsidiary. 100% holding, that's your wholly owned subsidiary. That is the meaning of associate subsidiary and wholly owned subsidiary, right? Now there are so many limits related to the alternate investment funds also. You don't have to remember each and every limit, right? Like category 1 and 2 AIF banks individual contribution shall be less than or equal to 10%. All the regulated entities together can acquire up to 20%. We have already done a circular on it, if you remember, AIF related circular. REIT, INVIT, important, right? This we have already covered in circular, right? It was there somewhere in, I will say, 5 to 6 months back. Then a video was also there on YouTube related to AIF. Then if I talk about REITs and INVIT, this is very, very important for your examination. Maximum 10% in any one trust. Overall investment ceiling will apply, right? So 10% is the limit for REIT and INVIT. What will be the relationship with subsidiary companies? The transaction will be done at arm length price. That means at the fair price, right? No preferential treatment, no favoritism should be there. No favoritism should be there, right? So these services you can provide definitely by forming different group companies like factoring, insurance business, right? Mutual fund companies, PMS. So this is the criteria, guys. This is the criteria. So the clear definition, this is the amendment, right? This is the amendment direction. This is not the full direction. This is the amendment direction, though we have discussed the entire direction. But what are the new areas? What are the new changes? We have seen a clear-cut definition of agency business and referral services. Explicit exclusion of the NOFHC entities. What is NOFHC entities? NOFHC entities means non-operative financial holding companies. There is a circular on non-operative financial holding companies as well, right? So non-operative financial holding companies will definitely discuss from the group entities. Now we need to always construct a NOFHC, which is actually holding shares of each and every company. So this company in itself is not doing any business. Rather, it is holding shares of each and every company. Let's suppose HDFC Bank, or let's suppose HDFC Life, HDFC AMC. So there is a group company which is holding shares of each and every company, right? So lending via the group NBFCs is also restricted here. PMS is only allowed through the group entity. So you have to create different group entity here. So these are the updates if I talk about this particular circular. And I will say this circular is applicable for the NBFCs, payment banks, small finance bank, commercial banks. That's why there are 4 circulars related to the undertaking of financial services published on the RBI website, right? So guys, that's all from my end for today. We'll be discussing about the next of the circulars in the coming parts. Okay, thank you so much for watching the videos, and please do cover all these circulars in a very crisp manner from the PPTs that I'm giving you, from the lectures that I'm giving you. Okay, so thank you so much guys. Bye bye, take care. In case if you are having any query, you can always reach out to me on my Telegram group, CA Prateek Finance. If you type CA Prateek Finance on Telegram, you will get my Telegram group. Okay, feel free to reach out. Thank you so much. Bye bye, take care.